Okay. That's getting that, that's getting that. Perfect.
It says before, but usually with group studies, I have you guys come bring questions, but for exam room studies, we're going to be going through chapter 1, chapter 2, and chapter 7. We're just going to go through all of the information down the list. And if we have any questions going through it, we'll work some things out. As well, I'm going to use the whiteboard to kind of work through, give some practice problems. You guys have some markers on the tables, and these tables are able to be written on. So use them to your heart's content. There's some of my favorite tables. I would like one. So when we do practice problems, I'll give you guys 5 minutes. I'll keep an eye on the clock, walk around. So if you guys need help, just raise your hand. Do not be afraid to ask any questions throughout this process. I want to help you guys succeed. Okay. All right. Is Micah here?
I just want to make sure that she.
We only have one eraser per table, but since we have 4 tables, feel free to take erasers until other people start taking tables. And we'll start just going through it. We'll go through chapter 1. So feel free to use your notes. Feel free to try to test yourself blind on these. But let's start going. All right. What is accounting? Don't worry. It's an information and measurement system that identifies business activities, records appropriate data, and communicates to users and decision makers. It's the language of business. It's where we report to people saying, hey, this is what we're doing. And they're able to look back and say, yeah, I think you're doing it. That's where we identify business activities. That's when we're buying and selling things. We're using supplies. We're using rent. We're recording our appropriate data, and we're communicating to users. Now, who are our users? What are external users?
Outside bodies that don't really, that can't do much.
Exactly. Any good examples, like any pinpoints? Because you got like the
Managers.
not managers. Managers are internal. Shareholders, investors, government. So those are our big 3. I think there's one more, but I could, customer. There we go. So all 4 of those are external users: customers, government. We have our investors and our stockholders. Internal users are our managers. They're anybody that's internal within the company. So we're all external users to Walmart, but we can all pull up their financial statements. I can say right now, hey, I want to see Walmart's balance sheet, and I'll be able to go on there and say, yes. There's all the assets, the liability, the equity. Also, for anyone that can't see too well up front, we also have the screens on the back. I just know like this is sometimes it's hard to see from all the way back there, so I always like to let people know. So we're going to kind of just go over and run through the opportunities, technology, and ethics and accounting. I don't think it's going to be too important to the test, but it's something just to keep in mind. Opportunities in accounting, there's 4 areas of opportunities: financial, managerial, taxation, and accounting related. Technology and accounting, we're dealing with AI, trying to figure out how we can make repetitive tasks even better so that we're taking much more of a data investigation role. Like we're like the numbers detectives. Ethics and accounting. Do ethics need to be in accounting?
Yeah.
Yep. Why do ethics need to be in accounting?
accurate information is like it's trusted or it's good information.
Exactly. It needs to be trusted. We can't just be putting numbers on a screen and saying, hey, we call that creative accounting. It's not great. I've seen people try to put expenses and revenues and expenses to try to make their looks look better. And trust me, we don't like that in accounting. I'm not talking about in class. I'm talking about in the real world too. That's how you be a not great accountant. What is relevance? So it is financial statement users, but what makes things relevant?
It's different financial statement users.
So by being relevant, it would make it different if it is or isn't.
Yep. So if it's relevant, so if I'm looking at a little startup store, when I'm looking at their financial and I see a whole lot of expenses, but I see very little revenue, do I want to put my money there? But if we change it around a bit and they have a high amount of revenue and little expenses, do I want to put my money there? That's what makes things relevant. When things can sway someone's decision, that's very relevant. So we try to put as much relevant data as possible. For example, again, with a startup business, usually they have high expenses. So I'm able to see what exactly they're expensing. And if those expenses seem very relevant for their first year of business, I might put a little faith in them and put a little money towards their way. But if I see them kind of putting their only expense being like wage, if they're only paying workers, but they're not putting anything to their business, I'm not putting anything there. That's just an example. Then we got faithful representation, which is accurately reflecting business results. It's again tying with those ethics where we want to make sure we're as accurate as possible and that we're trying to be as honest as possible. So we're just going to run through Financial Account Standards Board, FASB, writes the accounting standards for US GAAP. Anybody know what GAAP stands for?
Generally accepted accounting principles.
Perfect. Generally accepted accounting principles. That's the lay of the land. That's the rules we go by in public companies. And that's where we start going through all these principles and assumptions. So one other thing is the Securities Exchange Commission, SEC, governmental agency that oversees the US financial markets, and the FASB. So that's who we kind of report to. Now, I'm going to take a moment. I'm going to start writing all of these principles and assumptions down. And I want you guys to start telling me exactly how they're used and where you find them. So the first one we're going to kind of run by is the measurement principle or the cost principle. My apologies for the handwriting. My mother's a doctor and I inherited her handwriting. So the measurement principle, cost principle, what does it mean?
It's like assets should be reported there at the cost of doing.
At the date. And whatever the specific date is.
The historical date?
I think it says. Which, if you do it from the beginning or the end? I guess it just depends on which one it is.
You mean the beginning of the month or the end of the month? So that's usually for accrual, and it's depending on what you're you're usually doing at the end of the month. You accrue things at the end to kind of say, hey, this is all the stuff we haven't technically paid for yet. We're accruing. But that's going to be, we're going to get a lot more into that in chapter 9, I believe. But for this, it's not much with the date that's important, but it is with the cost. So with the measurement principle, the cost principle, it is anything is stated at its historical value. Writing things back for me. So what is historical value?
Like if they purchase something at $700, but they think it's worth something else, you put it down as what they purchased it as.
Basically, the price on the price tag is key here. It's exactly right. So like my best example is if we have a truck, I bought it for $10,000. I thought it was worth $12,000. The dealer thought it was worth $8,000, but the historical value is 10,000. We bought it for 10,000. It stayed at 10,000. End of discussion. So now we get to the one I think confuses a lot of people. Oh, come on. We're on measurements, principles, and not measurements. Yeah. Principles and assumptions. Now we're dealing with the revenue recognition. This is a fun one that you guys have to deal with a lot. What is a revenue recognition principle?
You recognize when a service is provided.
You recognize when a service is provided, but what are you recognizing? The amount that's expected, but what else? There's one big key factor here. What are we recognizing?
When it's the amount expected by the customer when you do the service.
Yes, but what are we recognizing when we do the service?
Revenue.
Revenue. So when when a service is provided, revenue is recognized. So we're gonna run through a little discussion here now. Hello, welcome in. We're on principles and assumptions.
Okay, cool.
So, with the revenue recognition principle being when a service is provided, revenue is recognized. When I mow someone's lawn, but they're going to pay me next week, do I recognize revenue?
Yes.
Yep. Cool. Sam, don't do this to me, please. We'll make it have internet connection. One way or another. Luckily, the board saves, and that's all that's important. Might be a little laggy on the recorded end, which by the way, new people, I am recording this and I'll be posting it up later today. If anyone needs to go back to anything or if other people want to look back on it that couldn't make it. Welcome in. We're on principles and assumptions. Meeting is recorded. So the revenue recognition principle, we do recognize revenue when we mow the lawn, even though we don't collect the cash next week. Now, when we collect the cash next week, do we recognize revenue again? Nope. Basically, our journal entries are going to look like this. What account do we use when we are providing a service but aren't paid yet? Account receivable. I'm putting AR because I want to make sure we save as much time as possible. What do we credit?
The same.
So we just mowed the lawn. We didn't get money yet. We know we were reporting account receivable for 100. That's our debit. Huh? Revenue. Now, also these boards can be written on. I've dotted some markers around if anybody wants to write on them, and there are erasers as well. So we do debit account receivable, credit revenue. Is anybody confused on this? Great. So next week, this is 1/1 on 1/8. We get cash. What's that journal entry looking like? Debit cash. Perfect. Debit cash, credit account receivable. We're basically clearing that account receivable out. We say, all right, that's this T-chart. Which learn to love T-charts. They're your best friend. we debit that account receivable for 100. So we have 100 in that account on 1/1. We then say, all right, 1/8, we take it out. And now it's 0. Does account receivable usually have a debit or a credit balance? A debit. So this is Vanessa. Anybody confused so far? Questions? Got it. All right. Now, let's do different situation. On the first, I didn't mow the lawn, but they gave me cash. What's gonna be that journal entry? Accounts payable, do we owe money? We don't owe money.
Funding revenue,
Unearned revenue, debit or credit?
right.
Credit. So it is a liability. So we do credit unearned revenue. What's our debit?
Oh, we got paid.
We got the cash. So we're not paying people. Wages receivable or wages payable. Wages receivable isn't really an account you're ever gonna use. Wages payable though is if you owe your workers money. But we would debit cash. The reason why is someone handed us $100, said, hey, mow my lawn. And we said, okay, we'll do it next week. That's gonna be a liability due to the fact that if I don't mow the lawn next week, I owe that man $100. Or if I don't give that money back, I'm more than likely gonna have bad consequences to my actions. Does this make sense so far? Okay. Now we're flipping the script. On the 8th, I mowed the lawn. What's gonna be my journal entry? Unearned revenue and revenue. Okay. So these are two separate scenarios. But even so, if this wasn't a separate scenario and this was just my day, I did both of these things today. The reason I couldn't get to this guy's lawn mowing is because I was getting to this guy's lawn mowing. So what happens is because I promised to do a job here, I have unearned revenue. Whenever you're getting rid of unearned revenue, when you've earned it, you flip it over. You say, all right, unearned revenue is debited because we did the job. We are no longer liable. I will not go to jail. And we said revenue because, hey, did my service. And what's the revenue recognition principle? Yep. Exactly. You have to provide service to recognize revenue. The moment that service is provided, revenue is recognized, no matter what happens. So even if we're getting paid beforehand, revenue can't be recognized. Now let's just say this guy handed me $100 and I did his lawn. What's gonna be that journal entry? Cash and revenue. All right. Any questions on our revenue recognition principle before we move on? Perfect. One of the trickier ones, that's why I like to stick around to it. All right. The expense recognition principle or the matching principle. What does that entail?
They record the expenses in the month that they incur it.
We incur expenses in the month we incur it. So does that mean if I buy rent today, so I pre-purchased rent for 3 months, am I expensing them all out this month?
No.
I can't. I have to wait till those months pass, say, all right, use up rent for this week. Well, not this week, that would be a bit annoying, but use up rent for this month, use up rent for this month. And you just go forward until you're all out of rent. And then we start the cycle over again. Any questions on this guy? You guys want to go over examples? No problem. All right. So we'll go through one of my favorites. I'm going to buy supplies. I think I'm gonna buy $1,000 of supplies. I'm paying half on card, half on credit. So, or half in cash, half on credit. What's that journal entry gonna look like? Yeah, so it's my debit.
Supplies,
Supplies. In this transaction, we're gaining supplies for how much?
1,000.
Perfect. How are we paying for the supplies? Cash and card. Not debit cash. That would be saying, hey, you're getting cash. You want to make sure you're crediting cash. So we're saying, all right, cash is credit, 500. What's also going to be credited?
Okay.
Account payable. Now, do we see any expenses here so far? Ooh, excuse me, sir. Do we see any expenses so far here?
Supplies?
Not supplies. Do we expense anything right here, right now? Not the cash. Cash is an expense. We're using it up though. Huh? It's a liability, but is it an expense? Nope. So, right at this point in time, once again, we're on the first of the year, we're saying, all right, nothing's expensed. I've used nothing up. I have not earned my expense. We only use the expense when we earn it. We're gonna now say, okay, end of month. We only have, we'll make it a nice number. We only have like $200 worth of supplies left. What does that mean? What's that journal entry to recognize we only have $200 of supplies? Not accounts payable. Are we doing anything with our debt right now? Is our debt being manipulated? No. Not using anything with account payable right now. If I said, hey, we're paying back our debt, hey, we're finally paying off that $500, that's when we're going to be using that account payable. But right now, we're only worried about the fact that our supplies, they've dwindled to 200. So I'm going to make a T chart to kind of make it more sense. And when you see problems like this, make sure you're making T charts. They're very great visual tools. So we know at this point in time we had 1,000. But at the end of the month, we have 200. How we get from 1,000 to 200?
Use $800 worth of supplies.
We used $800 worth of supplies. What does that look like? Credit. All right. So I'm going to put my 800 here. So we know, all right, at this point in time, I credited it. It's on my credit side. It's lowering 1,000 minus 800 equals 200. Think of T-charts as kind of like an equation. It's just like a visual plus and minus problem where everything in the similar column adds while everything in the opposite column subtracts. So we know that our credit is supplies. 800. So the end of our journal entry. What makes a journal entry? At least 2. And what's the big thing between this, between both your debits and credits? The equal. They always have to equal. So what's going to be our debit in this case? We know we credit our supplies. Our T-chart tells us, all right, 800 went bye-bye. It's an expense. At this point in time, we've earned our expense. We said, all right, all of these markers are gone. They're useless to me. We used them up. All right, supplies expense, supplies. This is what we call the matching principle, where we say, all right, the first of the month, we bought supplies, but it's not until we use them that we expense them. In this case, if we go the other way, we're gonna say, all right, at the end of the month, at the end of the month, I'm looking over my workers. I look and say, oh, it's the end of the month, but Billy Bob doesn't get paid till next week. So I have a whole week of work he's done. He was out doing whatever he needed to do for the company for that whole week. Do I just wait until he gets paid to recognize his hard work? Or do I recognize it now? We recognize it now. What's that gonna look like in a journal entry, y'all think? The scenario is, it's the end of the month. I have a worker that worked a full week of work at the end of the month, but I don't pay him till next week. Wage payable, debit or credit? Credit. It's a liability. We'll give him a nice paycheck. We'll give him that $800. So, what's going to be our debit? Hello, welcome. We're on the principles and assumptions, and I am recording the meeting and then post it up tonight. So, what's going to be our debit? Yeah, we're not paying him yet. So I heard a couple of answers. What was it? Wages expense. This is like the opposite scenario. Before this, we're matching it at the end of the month because we wait until we're using up the supplies. We can't, even though we have the supplies in hand, we can't expense it till we use them. In this case, it's the opposite. We're setting ourselves a liability, but expensing the amount because we're like, okay, we know that we used his services, but we're not going to pay him till later. So that's when we're expensing. Any questions so far on the expense matching principle? All right. Just kind of give newcomers little rundown. We're going to keep going, but anytime after, or we'll sit down and do some questions. Sorry, my brain is going way too fast right now. But I'll take some questions after we go through all the material first for anything that we went through already. And it's going to be posted up on YouTube tonight. All right, so let's keep going. We're going to go through the rest of these pretty fast because I think the big meaty ones are the revenue recognition and the expense recognition. Full disclosure principle. What's that mean? Huh? Everything's laid out. What's the biggest important piece of it? Financial statements, but what part of the financial statements is important in full disclosure? The footnotes. Footnotes. Full disclosure, footnotes. We have the footnotes. So going concern assumption. Let's go and concern assumption.
It assumes the company will continue operation.
Yep, we don't plan to close tomorrow. We don't plan to close forever. That's a going concern. No matter how bad the business is failing, we are going to keep looking to a bright future. Am I right, y'all? Next is the monetary unit assumption. What's monetary unit assumption?
Transactions are expressed in monetary.
What monetary are they expressed in? US dollars. Dollars, US dollars. As long as you know that we're all using the same money, that's the important part. Time period assumption. What's the time period assumption? We know what we're splitting up the business in. For example, my business, we split our timeline for quarters. So every quarter we have big book closes, but we also split up those by months. So every month we have tiny book closes till the big book close for a quarter. And we're just assuming, all right, we know how we split up the year of a company. We know, okay, quarter one, quarter two, quarter three, quarter four, month one, month two. We know how we split up our years. That's terrible even on my face. What about the business entity assumption?
What the business does is separate from the owner.
Exactly. We can't take the business credit card to go on a shopping spree. And it ties into our ethics. I think that's all of our principles and assumptions. Yep.
Could you zoom in a little bit? I'm having a hard time seeing it at a time.
Yeah, we also have them on the back, but which one are you looking for? This one? The one we just went through?
Yeah, so like just kind of a bit lower.
The lower?
Yeah, I kind of missed like down over left. Yeah,
There we go.
missed all of that.
You're all good. My biggest tips for studying the principles and assumptions, they're not going to be a huge part of your test, but they're going to be a huge part of understanding accounting. Kind of look for the key words in understanding these because all of them have some sort of specific. I'm just going to run through them one more time with the keywords that I associate them with. But obviously, when you're looking through these, kind of figure out, okay, how do I understand this? Because that way you're able to translate it to your own words and back forward. So measurement principle, cost principle. That's going to be everything is what it's valued at the price tag. Nothing else, or not the price tag too because of haggling, but everything is valued at the purchase price. What you purchase this for, no matter what you think, is what it is. Revenue recognition principle, recognize service, and recognize revenue when you recognize service. Expense recognition principle, recognize expense when you use it. Full disclosure principle, everything's laid out, footnotes. My big thing is footnotes. Going concern assumption. We're going to assume we're going to keep going. Monetary unit assumption. Monetary unit equals dollar. Time period assumption. We assume the time period. Business entity assumption, the business is its own guy. All right, gonna give one more minute, and then we're moving on to the next piece.
So for monetary unit assumption, what are like the exact words there? I'm in a little trouble reading it.
We all use the same currency.
Ah, thank you.
Yeah, of course. I was saying earlier, I apologize. My mom's a doctor and I inherited her handwriting. All right,
Hey, no worries, mine's not much better.
all right, so we good to keep going? All right. I'm not gonna erase things yet. At the end, if anyone wants to look through the board, you are free to look through the board. I will not keep this information away from y'all. But for now, we'll move on. All right. What is the accounting equation?
That's equals liability plus equity.
Awesome. I hope you guys have that second for the rest of your life. No. Accounting majors, I hope you have that stuck in the head for the rest of your life. Everyone else, it's good to know. So you got our assets equals liabilities plus equity. You don't have to be word for word for this, but what are assets?
Things you own.
It's things you own, it's what makes a business. So what about liabilities?
Things that you own.
Things that you can owe, your debt, your obligations. What about equity? True, but it's also what's funded into the business without debt. So not only is that for shareholders, but, and I know this is, equity gets a little confusing because it has a lot to it. And there's a kind of baseline understanding people have is you think, I've had someone come here think getting confused because homes, we call homes equity at times. But basically it's what we've used into the business without debt. This is where we house our revenues, our expenses, our net income, our retained earnings especially. Our retained earnings is a big one because that's what we've been able to put back into the business through blood, sweat, and tears. Not through any of the stockholders. We'll give them credit if they helped. But any questions so far? All right. So I'm gonna have you guys raise your hand. Well, I'm gonna have you guys raise your hands. Now we got one by one. I picked through people. But I want you guys to start giving me accounts for specifically assets. Then we're gonna go down for liabilities and then equity. So first assets,
Land.
land. Cash. Supplies and equipment. Inventory. Prepaid expenses. What examples of prepaid expenses are there?
Insurance.
Rent, insurance. Those are the two big ones. I think those are the only ones we really worry about. And principals. There's still some pretty big ones.
Accounts receivable.
Account receivable, that's a huge one. A lot of people come up to me asking, why is account receivable an asset? Account receivables can be sold to debt collectors, so we can still make money off of them. Even if someone does not pay me back what is owed, I can go to the next man over and say, hey, look, this guy owes me some money. If you give me some, if you give me a little bit of money, I'll let you be able to collect this whole bit. Huh? Buildings is another one, yes. There's also the case if your account receivable is big enough Like, let's say if someone purchased $10,000 worth of inventory from me, if they don't pay me back at the right time, am I gonna take some action against them? Try to get that money back? Yep. That's why we have a different account for liabilities. That's what they deal with. All right, so we got our building. I think that covers most of them. If anyone has anything else they want to go that they think is, let me know, but otherwise let's move on to liabilities. Oh wait, yeah, your hand?
Notes receivable?
Huh?
The notes receivable, you want?
Notes receivable will absolutely be one. Same idea as account receivable, note receivable, except that note receivables are even more law abiding. Those are usually you sign a contract, you sign interest away, all that fun stuff. I know we don't go through that in deep in the in-person class, so that's a good list. All right, liabilities,
Are all receivables assets or is that?
all receivables, all receivables. Anytime you see receivable, asset. Think of it, we're gonna receive it, so hey, that's good for us. So liabilities,
Unearned revenue?
unearned revenue, perfect one. All right.
Accounts payable.
That's probably good. Accounts payable, okay. I mean, you're right at least. But yeah,
Accrued liabilities,
accrued liabilities. What kind of examples of accrued liabilities?
wage payable and taxes payable.
Perfect. So we know receivables. If you hear the word receivable, you think of assets. When you think of payables, always think of liability. All right. Those are kind of the big ones that you guys have gone through so far. So we're going to end for liabilities there, but basically unearned revenue and anything payable. The moment you hear payable, what do we think of? Liabilities. All right, perfect. Equity now. We got some pieces of equity. Common stock. I do want you guys to raise your hands though, so that I made sure I could get everyone. All right. Retained earnings. Revenue. Dividends.
Expenses.
Expenses. I think that's all of them. Any last minute accounts anybody came up with that fits into any of these three? Nope. Great. So yeah, make sure you understand where assets, liabilities, and equity go. That is one big thing, and this is going to follow you through all of accounting. If this is something you have trouble with, I highly suggest get yourself a list of randomized accounts and just start filling out a chart like this until you understand it, because this, especially out of anything, is not going to go away. In fact, anything in chapter 1 and 2, it's very important and will not go away. So let's start talking about debits and credits a little bit. So assets. What do debits do to assets? Increase. Debits increase. What about credits?
Increase.
Credits increase? Decrease. So whenever we debit any of these accounts, that means we have more of it. So if I were to say our land, all right, I bought some land. Because I bought land, it's going to be debited, meaning it's increasing in the books. Same thing with cash. I just sold something and I made some money. So I'm going to be debiting cash. And the list goes on for any of these. Anytime you incur any of these, we're going to be debiting our assets and crediting whenever we lose it. So whenever we pay something with cash, that's a credit. Liabilities. Do we increase them by debits or credits? Credits. What about debits? What did debits do, Sean? Decrease. Equity? What increases equity?
Credit.
Credit. What decreases equity?
Debit.
Now, is equity special?
Yeah.
Equity is very special. So why is equity special?
Has other things in it that can be increased by debit.
Perfect. So we have things in here that increase with debits, but the fun thing about it, these specific accounts decrease our equity every time we incur it. So every time we incur expenses and dividends, we're decreasing our equity. We're saying, all right, dividends, we're losing out on our retained earnings. Expenses, we've paid more in the company than we've gained. And because of that, it's going to decrease our equity. So the statement's still true. Whenever we debit equity, we decrease it, and whenever we credit, we increase it. But it's just these two accounts here that if you're ever increasing them, they increase with debits, but in nature, because they're increasing, they will decrease your equity. Now, I think a lot of y'all already seen this, but something good to memorize. Dealer. Have you guys seen this before?
Yes.
Make sure you memorize it. Write it on the front of your test. If you have troubles with your debits and credits, this is the biggest tool I see. And I'm very much a believer that sometimes you have to fake it till you make it sometimes, especially in accounting in the beginning. If you have these little mnemonic, little devices that really help you understand where to get the answer, it's great. And then we can work on the understanding as you keep going. So what's the D in dealer? Dividends. Let's E.
Expenses.
Okay.
Asset.
L.
Liability.
E.
Equity.
R.
Revenue.
I love this acronym.
This is saying no on the left side increase your debit, and on the right increase your credit.
Yep. This is basically a T-chart. If we saw before where I was using a T-chart for our supplies, this is essentially just a shorthand T-chart for all of the accounts. Anything on the left is debits, anything on the right is credits. So real quick, what is the expanded equation for, what's the expanded accounting equation?
Or is it minus or retained?
Contributed capital and retained earnings. Here's your contributed capital. Oh, that is 4. Here's your contributed capital. Here is your retained earnings. I know retained earnings, I'm circling revenue, dividends, and expenses. Will you find revenues, dividends, and expenses in retained earnings? Yep. Your retained earnings is every revenue, dividend, and expense you've ever used throughout all of time. It's everything you've retained. It's just, we don't typically see them all together. We only ever see retained earnings by itself by the year end because we put all of our revenue, dividends, and expenses into our retained earnings. Do the financial statements, which we'll start going through soon. Let's see. Retained earnings, contributed capital, retained earnings. So I'm gonna run us through some journal entries. I know we haven't really gotten to the financial statements, but we're gonna run through them as well to wrap up chapter 4. I'm at chapter 4, chapter 1. I'm thinking of 4 financial statements. I apologize. So I'm just gonna start listing out a bunch of transactions. What I want you to do is use your note paper or use the boards, and I want you to start running through every journal entry. I apologize. I had laryngitis like 3 weeks ago, and I have yet to get rid of the cough. And it stayed with me. So I'm just going to start writing a bunch of transactions. Feel free to start the moment you see the first transaction. But afterwards, what I want you guys to do, make yourself a trial balance. Try to start on the income statement, statement of retained earnings, and your balance sheet. And I'm going to give you guys about 20 minutes from the moment I start writing on the board and we get that first equation done. I'll be walking around the room to help. So feel free to raise your hands if you're stuck on anything, have any questions. And then we'll just run through it together and go on to chapter 2. And if there's any issues, I make up these on with my head. So there has been issues, but at most times it worked out. Again, if some of this is not illegible, let me know and I'll read out loud and rewrite it.
The last part after cash.
Huh?
The last part after cash on number 3.
Okay. And the rest on account. Welcome in. We're working through some problems. Feel free to write on the desk, write in your notebook. The plan is, I'm gonna give you all about 15 minutes. You're working through these on your own. If you have any questions, raise your hand, but you're gonna try to, and you might not have enough time to, try to get through the income statement, statement of retained earnings, and the balance sheet, and writing out all the journal entries for each of these transactions. We're only given such a short amount of time due to the fact I really want to make sure we're able to cover everything. So we'll be able to have more flexibility at the end. And if anything's illegible, let me know. I know my handwriting's not the best. Oh, welcome in. I was saying before, we're working through journal entries right now and writing out the financial statements of the income statement, statement of retained earnings, and balance sheet. This is a brand new company too, so there's nothing beforehand. All right, that's all of the transactions. Once 115 hits, we're just gonna start going through everything here. If anyone needs any help, just raise your hand. Yeah, doing the journal entries, then trying to do the income statement and statement of retained earnings and the balance sheet. A lot I know in 15 minutes, so I don't expect you guys to finish it, but I want to see how far you guys can get. And we're just gonna run through all of that.
I got a question for number 3.
Yeah.
So it says we bought 1,500 of supplies using cash and the rest on account. So how much was done with cash and how much was the rest on account?
So how much was done with cash?
Oh, it has 500 up there. I didn't have that on mind.
I'll talk to you.
That makes so much more sense now.
The test will be more legible than my handwriting. That's the
No
important.
worries. I really am not that good at writing. That.
Yes. So the end of these credit, it's kind of like, you know, we have NLA format, EPA format. This is accounting format, where we're telling a story through like two little lines. The debit is right up against the wall while the credit has it. So the indent will always notate that it's credit. Anytime, like, say you really like for my countries, you're crediting your cash.
Is number 7 talking about number 5?
Number 7 is talking about number 5.
I'm not really sure what's in the here because of the accounts receivable.
That's perfect.
So that's being credited.
So, for number 4? Okay, he's been paid. How are they paying? Yes, there's always been something. So what happens when we provide services? Perfect.
I was worried about that too. So yeah, revenue is right.
Yep, revenue's right.
Yeah, I think I put service revenue on mine.
Hey, any revenue is fine. I know we're gonna be hearing like a lot of different ones like service revenue, time of sales, consulting revenue, it's revenue.
Did you put increasing revenues? That's not good.
So for service revenue, are you working on a journal entry?
Yeah.
So for journal entry, you want to put it in the credits, and then you want to put cash and debit since you're receiving 3,000 in cash. So revenue, if we look at dealer, that means that yeah, revenue is increasing in the credits. Yep.
Problem trying to get to the income statements, they were figuring out. So. What's Yes. Which is on. We're very good. Maybe it's like about 3 more minutes. Don't worry about like trying to rush through to the safe and all that. We'll still go over it through, and if you want to keep working through while I'm explaining, don't worry.
All right.
Yes.
So for number 7, it said we collected for the time previous no credit. So I'm assuming that would be number 5.
Mhm.
So then I basically just got cash at 1,500 and accounts receivable goes down.
Perfect.
All right, that's good then. We'll be back in a couple of minutes and you fetch some water.
No worries.
Number 7. And it's not number 1. You can do cash or you just switch it and put revenue.
So would we take away revenue when we provide the service? Exactly. So we're not gonna swap it, because that service we provided, we can't take that away from us. We're very proud of that service. As for getting paid, or if we collected, it means we had to pay.
Sometimes receivable.
Account receivable, debit or credit.
Debit then.
So
Is it still on credit? No.
it's gonna be on credit, because think of it this way, they're paying off their debt.
So what would be in debit? Is really-
How are they paying off their debt?
it's, uh, it's a certain amount.
Hey. Why are they saying?
Here
here. What I do, I'm like,
Oh, no, not at all, not at all. I'm just surprised. I didn't know you were coming by here today. Missy?
told me room 106.
Huh?
They told me room 106.
Yeah, absolutely. So we collected for the client previously on credit. So it isn't like in phase one. Exactly. Okay, that's what I was thinking. So, thank you. So, no, that wasn't you.
That's why it's like, wait a minute. They gave me the wrong thing.
Wait, are they doing a?
Yeah.
Oh, innocent.
Yeah.
Okay, I thought because of the emails, I thought you were going to.
No. It's just like they do Wednesday and Friday. So I'm like, okay. It's like 1 to 3. So
Okay, awesome. I don't understand. Jeremiah's.
I'm just hoping to win this.
So, just let them know that they gave you.
But fair enough. I was like, wait a minute. I see Monty in here. This is weird.
Okay.
See Monty.
All right. We're gonna start running through all of these. So. We're gonna check your answers while we're going through this. Feel free to go ahead if you feel confident and try to do the income statement and the other financial statements, but we're gonna run through everything one by one. So first, we invested $20,000 into the company for common stock. We're debiting cash to $20,000, and we are crediting common stock. Any complaints? Awesome. All in agreement. We purchased $6,000 equipment on account. So that's going to be debiting our equipment because we have gained equipment. And we are crediting our account payable because we have yet to actually pay this off. We bought 1,500 of supplies using $500 in cash for the rest on account. Now we're going to debit our supplies for 1,500. We're then going to credit cash. Ooh, a little bit. 500. We're going to then credit as well account payable for 1,000. Next, the client paid 3,000 for services we provided. Easy, cash, and we're crediting our revenue. As I said before, on the test, you don't have to worry about specifying the revenue. We're not worried about service revenue, sales, or anything like Connect, but just know that, hey, provided service, some kind of revenue. We're right now just running through some practice problems. We're gonna go through all the journal entries for it, then going through all the financial statements. We can do some more practice problems at the end, but we're just gonna keep going to try to get through all the material, and I'm also recording as well, so this will be posted up tonight. Clients billed for $1,500 worth of services provided. So we haven't got cash yet, so that's gonna be our account receivable. For 1,500. The next is again revenue. For that same 1,500, because we still provided the service. And once again, one thing I do want to say, commit to whatever revenue you're using. So don't use 5 different types of revenue. If you use revenue here, just keep using revenue, because no matter what, revenue or service revenue, sales, make sure you're using one word just so you're not confusing yourself. That's my biggest tip. Now, so far, any questions on any of these? Good stuff. All right. We then paid our employees $500 for the week. We're going to use wage expense. And then we're going to credit cash because we paid them right then and there. They don't have to wait for anything.
Good question.
Yes,
Will we need the word like wage there, or is expense just fine?
you're gonna need wage, salary, anything that specifies what kind of expense it is, because especially when you have like 3 to 4, I made this problem a little bad because I didn't add more variety to our expenses. But let's say if, like we had 5 different types of expenses, if we just called them expenses, those aren't great. And in fact, that, like, I'm glad you guys know that's the expense, but you really do have to specify, hey, is this rent expense? Hey, is this supplies expense? Hey, is this, what kind of expense kind of deal? Because especially then, let's say, this is more to do with tax class and more of why we do it in accounting than the kind of end result in accounting, but for example, a lot of the reasons why we specify the expenses is so that when we're doing our taxes, we're able to deduct things. We're able to say, all right, this is how much in rent, this is how much in this, because the IRS does not like just saying expenses. Trust us. They like to see us put a little work in it. All right, so we collected for the client previously on credit. The only client that was previously on credit is this guy. So we're able to then say, all right, pay cash, credit, account receivable. So that's at 1,500. All right, then we paid $300 of dividends. So we know dividends are a debit of 300 and a credit of cash. So that's going to be all of the journal entries for this problem. Any questions on any of this before we move on? Yes.
So if we purchase this, it's only
Yes, if we're ever purchasing anything that says paid, or it doesn't say account, it's straight up cash. And you're never gonna pay, you're never gonna use account payable for dividends. At least in this class, if any of y'all are going to like intermediate accounting, we have things called dividend payable, but I'm not gonna get into this for 2301. I don't think you don't. We're gonna keep up to the basics.
Did you debit the dividend?
Yes, we've debited the dividend. Anything else? Yes.
For number 1, can you just explain why you would debit cash?
So the reason why is because we invested 20,000. I know that's very vague, but it's supposed to be vague so you guys can try to get those context clues. If we only say, hey, we invested 20,000, that's us basically saying, yeah, we put 20,000 in the business, we put $20,000 cash. Now, if I said, because this is a good question, and this is all about context clues. Accounting's all about context clues, categorization, and figure out what means what. And sometimes it does get tricky on the wording. But like if we said, okay, we invested $20,000 of equipment, are we debiting cash? What are we debiting? Equipment. If we're then saying, all right, we invested $20,000 of supplies, which I don't know why, but we did. Debit supplies. It's kind of like this context clues. So if you have nothing else, especially for a question like this, where it just says, hey, we invested 20,000, it's gonna be cash. Same thing on a lot of these questions where we're seeing account. Hey, we purchased $60,000 of equipment, but because we have account there, we know, oh, we used the credit card. We didn't pay with cash yet. Any other questions? And did that help answer your question?
Yes, thank you.
Of course, yes.
You want to read about question 7?
Yeah. So question 7, what's confusing about it?
Just about the previous.
So the reason, again, I use like specific kind of confusing wording. I want you guys to be confused here than on the test, because then you're able to be a little more vigilant. We collected for the client previously on credit. We know the only client here, because we're a new business, the only client we had was number 5. That was our only account receivable. So the client we collected for previously on credit, hearing that a client, that we collected something previously on credit, the credit is the client's credit. So that's them on their account. Another word I could have used instead of on credit, I could have used account. Yes.
I think the biggest hint is that it doesn't mention anything about cash. It just says that they're billed, which means they haven't necessarily paid yet.
So definitely. So right over here where it does say billed, this one says paid. So whenever you see bill but no pay, it's 1-for-1 account receivable.
So when we see collected, it just means cash, right?
Yep.
Every time?
Every time.
Okay.
Anytime we see collected on accounts or stuff like that, that's us going around and saying, hey, here's my money.
So on 3, you credit the cash because it says the supplies.
Yes, you said, well, you credit the cash because it says, okay, we paid $500 of cash. So, and because we paid with $500 of cash with the rest on account, we know our supplies, the net worth of our supplies, that bill that we received is $1,500. But we only paid $500 of cash. I only had $500 with me that day. Any other questions? Y'all feeling good? Great. All right. So we're gonna keep the train going. I'm gonna make some T-charts for big boy accounts like cash. I think specifically cash and revenue, because those are the ones we've used the most. But I highly suggest, if it helps, make T-charts for everything. So for cash, I know 20,000, 500, 1,000, 100. If anyone's confused with what I've been doing here, let me know. But this is a T-chart. Basically, every time I did a debit, I put in the debit column. Every time I did a credit, I put in the credit column. You can use this in the account to get that grand total down here, because I basically minus, I took whoever had the biggest half. So I subtracted out 13,000 out of 24,500, and that's how I got 23,200. So now we're doing our income statement. How does the income statement work?
I have a question.
Yes.
So if you take the bigger half, whichever is bigger, it's gonna end up on that side.
Yep. So what's our income statement? Expenses and revenue, but how do they relate? Those are perfect, but how does the equation go?
The revenue minus expenses.
Revenue minus expenses. So our income statement is revenue minus expenses. What does that equal?
Net
Net income. So in this case, our revenue, I've already calculated here, it's 4,500. And our expenses are a whopping 500.
Mhm.
I think we did good for this business today. All right, so our ending net income is 4,000. Now our statement of retained earnings. I'm not gonna write it all out because it's very long, but how does that go? How does our statement of retained earnings go?
The net income minus dividends.
Net income minus dividends, but there's a little more to it. What's the last piece we're missing? I will say, I'm asking for the baseline. I know we don't have it in this
Oh,
problem.
the beginning routine.
Beginning retained earnings. Always look for your beginning retained earnings. That equals our ending retained earnings. I like to say we're updating a retained earning account. Basically, if we saw a balance sheet with our with our retained earnings, expenses and revenues, we'd be able to first find our net income and then take that retained earning account, toss it at the top, add our net income minus our dividends equals our new retained earnings. Now, we had no beginning retained earnings here. We had $4,000 of net income. We then have to take out how much dividends I give them? 300. All right. Any questions so far? Yes,
So that last part, at the bottom, what's that saying?
that is saying statement of retained earnings. So I've shorthanded it because it's very long to write.
Statement of retained earnings. I'm not gonna remember that. We could just put statement of RE.
Yep, that's why I just put sore. So
It's so sore.
it's so sore. We got our beginning retained earnings, net plus net income minus dividends equals ending retained earnings. In this case, we had no beginning, so we have a 0. Our net income was 4,000, and then we took out 300. So at the end, that's 3,700. Yes,
So if you had beginning retained earnings, you'd also subtract it from everything else.
you would add it in there actually. So it's what you start off with. So let's actually give us a little bit of retained earnings. We'll say we'll give ourselves 100. So if we had 100 retained earnings at the beginning, we would then add that to 4,000. So 4,100. Then you minus out 300. Your ending retained earnings would then be 3,800. That makes sense? Awesome. But for the continuity, I will keep it to 0. All right. Last thing is last, we're going to start going through our balance sheet. So that's where we take a look at everything laid out, start really working some grease into it, working our magic. Our accountants like all. Here. The way I make balance sheets is my own little way based off of Connect, but feel free as long as you know how, well, as long as you make it very clear where your assets, liabilities, and equity are and what has to equal what. Those are the big key things that are important. So I like to say, all right, here's my assets. Here's my liabilities. And we'll have our total. Let's see. First things first is cash. This will be the key thing to tell me if I made this question wrong. Real quick.
Does it matter what order it's in?
Yes. So have you guys gone over the classified balance sheet yet? Sorry. So current liabilities go first. Whatever can be used up within a year. Can we use up cash within a year? Oh yeah, boy, we can use up cash real fast. Supplies, can we use that within a year? Equipment, do we want that to be broken by the year? No, that laptop cost me good money. I want it to at least last me 3.
It wouldn't change the outcome.
Would it change the outcome of the total?
But it would be counted wrong if we put it.
Yes, because typically one of the big reasons why you lay it out like that is due to the fact that you want to separate your current and your long-term liabilities, or liabilities and your assets. It's nice for the financial reader, but at the same time, there are specific equations you have to separate out your current and your long-term assets. This is typically going to be talked about more in managerial accounting, so that's going to be next semester, but just understand current and long-term. The reasons why will be unfolded later on. So, how much?
So, you have to. Dividends in there.
Dividends is equity, but is that going to be showing up on our balance sheet? Nope. We folded that into our retained earnings. Think of it this way. The income statement and the statement of retained earnings is like us taking putty and smushing it all together to then get a new retained earnings. So how do I know that I did this right?
It should equal.
Yep. Everything equals. My total assets equal my total liabilities plus equity. What's the accounting formula?
Assets equals liability plus equity.
Assets equals liability plus equity. That's why I kind of separate it all out. Does this make sense? Any questions? Nope. Perfect. This is a balance sheet. This is very bare bones, but it kind of gives you guys the best understanding. Everything is where it needs to be. Everything balances out. And everything's been accounted for. This is your income statement, your statement of retained earnings. I think with that, that kind of wraps up chapter 1.
Could you zoom in on the equity part currently? All right.
I'll leave that on there. We'll start going through chapter 2. Now, chapter 2, we're going to go by real fast. I want to save a full hour for chapter 7. Chapter 2, we've basically been doing chapter 2 this far because chapter 2 was our debits, our credits. Our recording our transactions and getting really deep into the financial statements. So we're just going to start reading through the notes. If we have anything we got to work through, we'll work through it. But that way, chapter 7, I know you guys love it, right? Yep, that's what I thought. Makes y'all feel better. I got through chapter 7, but I never understood it till I tutored it. But if you can get past chapter 7, the rest of the semester will be at least a little bit more tolerable. At least in my opinion. So we have the accounting cycle, which the biggest things we've been focusing and working on is analyzing transactions, what we've done, recording some journal entries, what we've done. Mind if I move it around now, or do you still need it?
Yeah, no, we're good.
Recording to our ledger, which I did not do the best, but for time reasons, we're only worrying about 2. But typically, you would record all of these into a T-chart. If it probably won't ask you on the test to record them, but it's always good practice, especially if cash is going in and out, in and out, in and out. Best way to just kind of keep track of it. Prepare unadjusted trial balance. We didn't really do that, but that would be before we didn't need the income statement, the statement of retained earnings, we would just list them out with their totals. So that would basically just be everything plus the retained earnings split into our revenue, expenses, and dividends. We all know what account is. So, what is a definition of an account? Can you speak a little louder?
Record of all increases and decreases in amounts of liability, equity, revenue, and expenses.
Perfect. So it is basically a record. We're keeping a record of all of these. Each account is very specific to us. Every company has very specific accounts. If I were to use an example where I work, because I work at a real estate company, we have a very big focus on a lot of fixed assets. And fixed assets are like not equipment. We don't worry about equipment. Instead, we're worrying about apartment unit turnover. We have Q2 2024 unit turnover as one of our assets. That would be under like putting it over here. If we erase the equipment and put unit turnover, that's a very specific account to me. What about ledger?
Record of all accounts and their current balances.
Record of all accounts. It's basically a whole page of these T-charts telling you all the amounts we've put into them and what their ending total is. Chart of accounts. Perfect. Basically looking at all of the ledger accounts. We see our cash, our equipment, our everything kind of just put out there. So you know what we're using. It's good to kind of know the definitions of assets, liabilities, and equity. You might be questioned on them. Assets, we've already went over like a baseline definition, but as the notes say, assets are resources owned or controlled by the company that have expected future economic benefits. Liabilities, obligations to transfer assets or provide products or services to others. Equity is the owner's claim on a company's assets. The owner's residual interest in the assets of the company after subtracting liabilities. A lot of this goes into the rules of a journal entry. So the rules of a journal entry, what is the minimum number of accounts that you can use in a journal entry? 2. Is there a maximum number? I can use as many accounts as I want. Now, is that recommended? No. So if you can, try to make sure your transactions stay within your transactions. So instead of doing a journal, if I were to do a journal entry for all of us at once, that would suck. And that would probably be very confusing for me and others. So how do I know which one of these is a debit and which one's a credit? I understand what you're talking about, but I'm talking about what it looks like. You're welcome,
The
man.
debits on the top and the
Yeah,
credits.
debits
in
on
the-
the left and credits on the right.
Perfect. That's great for a T-chart, but also here, if we notice, our credits are indented. They're always going to be indented. Our debits are always first, and they're pushed up against the wall. So we are able to easily look at this and really see what we're working with. A great example of why we do this is if I were to take this eraser and just say, all right, goodbye transactions. If it will, there we go. If I erase everything here but the journal entry, there's a big thing I really want to push. And this is a great study tool too. If you have a lot of trouble doing journal entries, one of the biggest recommendations I tell students is to write a journal entry or just look at the journal entries without the transactions descriptions. Because the cool thing about journal entries is it's going to tell you exactly what you need. Debit cash, credit common stock. The owner invested money into the company. I'm going to move over so you can see it. So I know exactly that we got cash because it's debit, meaning that we gained cash in this transaction. And because common stock is credited, I know it's because of our investors. Equipment for 6,000 on a debit, credit account payable. I bought this on a credit card. This piece of equipment here, this smart board, $6,000, pristine condition. I use my credit card. I'll pay it back later. Supplies is debited for 1,500, cash is 500, account payable 1,000. Well, when I went to Walmart, I had $500 on me, but I told them to pay the rest of it later, and they said, okay, have a good one.
So this is gonna be like uploaded, right?
It will be uploaded as well. Unless Zoom says otherwise, I will put this up. So, account payable, 1,000. Cash, 3,000, revenue, 3,000. One for one, I mowed the lawn and someone paid me a lot of money for it. Going down, account receivable, 1,500, revenue, 1,500. I mowed someone's lawn, I guess I'll get money later. That's not too important yet, but I have their name and number. I will go to them. Have a good one. Wages expense, 500, cash 500. I know because wages expense is debited, my workers did a fine good job this week and I'm gonna pay them. And because I credited cash, I paid them. If it was a wages payable, does that mean I paid them? Nope. Yep, it means, oh, I see that you worked this week, but you're getting paid next week. Don't worry. And it goes on and on, like cash 1,500, account receivable, because I can tie back over here and see, oh, account receivable 500, 1,500. I collected that money. And that dividends, well, I paid someone some dividends. So, any questions on reading accounts backwards? It's a great practice and study tool. Journal entries are, the reason why we set these journal entries like that is so that they are readable backwards. We're able to see what transactions happened just by looking at the journal entry than having to go back and reading, oh, Bob went to the store and bought some supplies kind of deal. We went through dealer. Went through statement of retained earnings. So yeah, we went through all the general ledger. So we reported transactions. Have a good one. Remember, your additional practice on these notes is integral. It's very useful. They're probably they look very similar to the workout problems that you will use on the exam. So it's great practice. So I'm just going to say these accounts out loud. I want you all to tell me debit or credit. Okay? So this is their normal balance, what they increase by. Prepaid rent.
That's debit.
Debit. It's a debit because it's an asset. But you guys are all right. Common stock.
Credit.
Credit. Note receivable. Debit. It's a receivable. What's a receivable?
Assets.
Asset. Assets increase?
Debit.
Debit. Perfect. Account payable.
Credit.
Credit. Equipment.
Debit.
Dividends.
Debit.
I'm hearing a whole lot of mixed answers and I'm here to let you know, debit. Yep. So dividends, do they increase or decrease our equity?
They decrease.
They decrease it. So if we look over here in our statement of retained earnings, we see specifically this minus sign in the dividends. Our retained earnings, do they increase or decrease our equity? We like to hope they increase, so they are a credit amount. But because dividends subtract from retained earnings, think of it this way. Put a little T chart here. Retained earnings. That net income was 4,000. So, oh, wrong side. My apologies. 4,000. That dividend was 300. So that's why we know that it debits, it decreases. So equity does increase by credit, decrease by debit. But dividends special, it's under equity. But boy, do we not like it. Well, okay, we do like it in some cases, but it doesn't look nice. So, unearned revenue,
Credit.
credit. Now, this one's special because I really want to make sure you guys know it. What is it under? Assets, liabilities, or equity?
Liability.
Liabilities. Utility expense,
Debit.
debit. Again, if we look up here in our income statement, once again, that expenses is minusing from our revenue. It is lowering down our equity. So it will increase with a debit. It is a normal debit balance, but boy, do we not like it. But it is nice. In all honesty, expenses are nice because then you get taxed less the more expenses you have. Something to keep in mind. And that's just as quick as I can go through chapter 2, because we kind of mix chapter 1 and chapter 2 together because they both really do go hand in hand. If you have trouble with chapter 1 or chapter 2, I highly suggest focusing on that before anything else. I know chapter 7 is a tough one, but chapter 1 and 2 is the foundation of all of accounting. You will need chapter 1 and 2 going forward through every chapter. And if you're struggling with that, please let me and Miss Yeager know so that we're able to find ways to help you. And for anyone in Miss Yeager's, I think everyone here is from Miss Yeager's class, right? Raise your hand if you're not in Miss Yeager's class. Okay, great. I offer this group study to everyone, but mostly use Miss Yeager's class. So I get to see y'all's faces. But I sent everyone blue kits, which you guys should know by now are little games based on, I have a lot based on chapter 1 and chapter 2 and a little on chapter 7. And then we have the whole study guide that I have made, not a reflection of the exam, but it's very great to test your knowledge. Let's start getting into chapter 7 for this last hour. But any last questions for chapter 1 and 2, or do we feel pretty good? Okay, I believe in all of you.
I've been waiting for the chapter 7 one because it's been so confusing. Like beginning of the week, I was just like, I'm completely lost.
Oh yeah, no, chapter 7. Yeah, no, chapter 7 is a doozy. I will say, not every chapter is like chapter 7. Chapter 7 is a beast in its own right, and even I didn't understand it till I tutored it. But if you can get past chapter 7, even if it's through the bare skin of your teeth, all the other chapters are pretty manageable. None of them are as much as a pain as chapter 7, and I will be very vocal about that. The irony of it, though, is now I'm on the bad debt project at my work. So it is very, very fun. I like to think I know it now. All right. We're going to go through the beginning with sales on bank cards and just talking about account receivable. We all know what account receivables are, right? What are they? Money owed to us, an asset, sales on credit. Anytime we see us bill a customer without them paying, anytime we see a credit, they pay it on credit, they pay it on account. Anything with those key words, no, we have got no money yet, but we're waiting and we're patient. Receivables amount due from another party. The most common receivables are accounts receivables and note receivables, but could be interest receivables or rent receivables. Basically, receivables are assets. So, if we're talking about control accounts, what are control accounts? They are the hub of accounts. Think of this as like the central hub of the central hub of what makes up our account receivable. Now, the numbers in here are all very specific. We have 300, we have 200, we have 400. Each of these are by different people. So we start having these things called subsidiary accounts, where we can then see where these balances come from. And how they flow within and out of each other. So over here, we're able to see, okay, we have three balances housed in our account receivable at a total of 900. But we're able to see that these balances are contributed by three different subsidiary accounts. We got Steve, Mark, and Sally, all of them owing us money. They are little subsidiary accounts that we're like, okay, you can pay us back later. And as you can see, some of them already have some activity to bring them down to that kind of balance. So we're able to really see, okay, Mark and Sally owed us more, but Sally paid off a lot more, while Mark paid us half of how much he owed, but that's okay. At least we know they're paying. And Steve, we're not too worried about it. It's only $300. Hopefully we get that back later. So. Sorry, guys. This is what we call a control account. This is account receivables, our main hub. Our subsidiaries are the little guys on the way. Any questions so far? Nope. Oh, yep.
For the secretary accounts, so it helps, the numbers on the credit side, that's showing that.
No, that's how much they've paid off.
Okay.
So what's on the debit side is how much they didn't pay. That's how much they owe us. Everything on the right is our cash collections. That's every time that we took $600 back from Sally, so it's 400. Mark, we took 200. We could also say, because we wouldn't know until we looked further into it, did they pay us or did we write off that balance kind of deal? Because we're going to get into that later. So we're going to run through any other questions on account receivables like this. Nope. That is a very good question, though.
So in other words, the subsidiary accounts, it's basically like the accounts with like what people are owing us stuff.
It's us breaking it down. We're able to really say, I need to go contact Sally later for the rest of that money. It's us being accurate. All right. So we then have sales on bank credit cards. There's 4 reasons, and I think we only really need to know the reasons of why. So the reasons why we have say people will accept credit cards is we get money faster. I'm not going to worry that you're going to owe me money as long as you pay on a credit card. Then the credit card gets to worry about your account receivable. Okay. Running through chapter 7. So we avoid the risk of a customer not paying. We know that person technically now owes that liability to someone else, but we don't have to worry about it because we got cash in our pocket. We receive cash sooner, and usually we have higher sales because people are more inclined to go buy things when they have a credit card. That's something to keep in mind whenever y'all get credit cards is be careful, make sure you're spending what you can pay back.
It's not real money.
Yeah, it's not real money, exactly. So we typically pay a credit card fee. And how this usually looks is when we are saying, we'll keep using Sally. If anyone in here is named Sally, let me know. I'll pick a different name. Don't think I've seen any Sallys yet. So. Out of this, ignoring the credit card bit, what do we do when we do a service? What do we record?
Revenue.
Revenue. How much is our revenue here?
200.
200. So this is our, what I love to call rock account. This is our stable account. We have no other credits. So we know, all right, revenue, straight up 1 for 1, 200. How much of that revenue did we get to pocket? Huh? Not 5%, but 95%. 5% is taken away because it's a credit card fee.
Attention, room equipment usage.
It does that. You guys, after 2 hours, it will start yelling at me. So I've gotten sassy with it. So $200 is our revenue. I am then going to take my 4-function calculator. Pretend this is a 4-function calculator for your exam. Don't actually use your phone. Gonna times it by 0.95%. I know that my cash is 195. Wait, no, my cash is 190. And my credit card fee is $10. So 95% times 200. So we're basically saying, because we're not going to charge the customer more. It is what it is. That $200 is our revenue, but that $10 is our credit card fee. Yes.
So the part where it says using a MasterCard with a, what's the last word?
A 5% fee.
5% fee. Okay, that makes so much more. That's where the 5%'s from.
That's where it's from. So how we got here is this is 200 times 5%. This is 200 times 95%. If you really want to get nuanced with it, this is 200 times 100%. That's kind of where the baseline structure is. I don't know how important it is to know to calculate. Just know this is your baseline, and this is how you break it up. And know that credit cards are used to get paid faster, have higher sales, and also we don't have to decide if a customer has credit because they're paying over credit card. The credit card company gets to decide it. Basically, we shove everything else to the third party, and we get money now, even if it's a little less. So we're now going to start getting into the fun part of Chapter 7, uncollectible accounts. Hear you all cheering in your souls. So we have 2 specific methods for our account receivable. We have our direct write-off method. Now, we're going to talk about direct write-off first, then we'll start going to the allowance method. The direct write-off method, is that gap acceptable? No, we don't like it. Do we deal with an allowance? For the direct write-off method, do we deal with an allowance account? Nope. Generally accepted accounting principles. It is what we live by for public accounting because GAAP is what keeps us honest, or should keep us honest. That's why we have all of those fun principles and assumptions you guys get to deal with at the very beginning. So no allowance. Do we know what specific principle this offends? Yep, expense recognition principle. We are not expensing in the time period that it's technically been accrued. kind of give it a timeline. We have year 0, year 1, year 2. Someone here is where, right here is where we made a sale on credit. And we don't know this person went bankrupt until we have to write them off here. Because of this, this is where our expense is. But GAAP wants this expense here. Now, can we go back in time and expense? Because we only found out exactly. We don't. I saw some nods, some head shakes, so that's why. But yes, we technically, the reason why we have the allowance method is so that we're able to recognize an expense in the year that it happens, because we are not psychics. So instead, we're making assumptions and estimates so that we're closer to expensing in the time period it's recognized than just waiting till the expense happens. Now, if you are asked to write off an account with the direct write-off method, does anybody know the journal entry? So I'm gonna write it here. We're not gonna worry about it too much, but you'll take your bad debt expense. And we're gonna credit our account receivable. We're basically just writing off the account and tossing it into expense. We're saying, oh, you're useless to us now, goodbye. Lowering our account receivable, taking that away, and then instead of having a bad debt expense. Now let's go back over here. We're gonna keep picking on Sally. Sally said she can't pay us back. She showed us the appropriate reasoning why she went bankrupt and that we can't get her money. Because we can't get her money, we then have to do bad debt expense of 400. We will then credit account receivable for 400. And if we were to update our T chart, we then have 400 down, 500 in account receivable. And we call it a day. It's pretty easy. It's pretty direct. Direct write-off method, direct. Fun joke. But that's not what we get to do. Exactly. Instead, we get to worry about what's called the allowance method. And we're specifically focusing on account receivable allowance, or otherwise known as the balance sheet method. The reason why it's called the balance sheet method is because where do you find your account receivable? Balance sheet. It might seem a little more confusing why, because we don't get into all of the different methods, but there's an income statement method and an aging receivable method as well. So the income statement method is based off of sales. And this is just fun facts, especially for accounting majors who are in here, and you'll have to learn them later. So this one's the most difficult one of them all. Well, not really. It's not as difficult. Huh? Account receivable.
Oh,
I'm making things sound scarier than they are, but this isn't as difficult as it seems at first. It is really just getting comfortable with the method of how it's done. So how the account receivable method goes is that you take your total AR, all of that account receivable, you take a percentage, so you multiply it by a percentage. You then get what you call your ending ADA, allowance for doubtful accounts. This on the side. You then take this ending ADA and you go to your ADA account and toss it at the end. Now, does it normally have a debit or credit balance? Credit. Now, sometimes when you're putting the total, is there sometimes a balance in there already?
Mhm.
Yep. Is it always going to be credit?
Mhm.
Nope. Sometimes we overdrawn the account and we put IOUs in the cookie jar and say, okay, I'll bake some more cookies later. So we can have a beginning balance rather here or here. After that, you figure out, okay, how do I get from here to here? I know I'm kind of like, I'm being very vague about this. I want to kind of go over the process first. Then we're going to go through an example equation, try to run through that, and we'll get into it in more detail. So you find out what this box is, and what that box is, it's going to be what your adjusting entry is. Your adjusting entry, anytime you see adjusting entry, always think bad debt expense. And you credit allowance for doubtful accounts. Or ADA. We're not just right off the bat taking away our account receivable, we're putting a balance into our ADA account. We're figuring out the total because basically we want to know exactly how much we want to put in there. We want to know, okay, if I have 1 in my ADA account, but I want to get to 5, I know I need to put 4 in. Putting 4 in is by doing this journal entry where we credit allowance for doubtful accounts and debit bad debt expense. Will you ever see these guys swapped? No.
No.
So always know, you'll always see them in this order: bad debt expense and allowance for doubtful accounts for an adjusting entry. You will never have to reverse them. So it's good to know them in this order. Now, when we're writing off an account, when we write off an account in the allowance method, we then have our ADA, allowance for doubtful accounts. I just don't want to write it all out. And we credit our account receivable. Whenever we see a write-off, that means someone can't pay us back. Sally don't have the money. So we debit our allowance for doubtful accounts because we're taking away from that allowance. And instead we're crediting our account receivable because we're taking away that account. We're saying, all right, it's gone. Now, will this ever be reversed? Will you ever see this reversed?
That's what I was thinking of.
So this one, if we'll say Sally came back, said she's sorry, said here's $400, we would then have to reinstate the account. To reinstate the account, you would swap over account receivable in ADA. And then you will do cash collections. Our favorite part of the day. Now, how many times through this process do you see bad debt expense? Once. Do you think an accountant's going to use bad debt expense through the whole year with the allowance method? Nope. When do you use bad debt expense? Huh?
The end of the year?
The end of the year, yes, but specifically, what's the key words to know when to use bad debt expense? Not when it's uncollectible. That's called a write-off, and that's going to be these 2 entries. So what did I call the bad debt expense entry?
The
It is a debit, but what did I call the entry?
adjustments.
Adjusting. Whenever you hear the words, let's adjust our allowance. Let me get some of the examples. So In your notes, under the percentage of receivables, it says find your ending account receivable balance and allowance for doubtful accounts before adjustment considering all sales payments. Step 3 says find necessary adjustment amount and record adjusting entry. Let's go to another. Another good word, sometimes this is why I'm looking through the notes to make sure for all the verbiage. Another good keyword for adjusting is updating. So updating, adjusting. So step 1 in the high tech company problem, recording to the transactions and update. Step 2, record year-end adjusting entry. Something very important to do is going through your practice problems and finding the key verbiage. Does that make sense, or does anybody have any questions so far? Okay, just making sure. But you see what I mean when we're finding the call-outs for adjusting and not for write-off. So if we were instead told, hey, prepare the journal entry to write off the counts. We're specifically calling out to a write-off, and that doesn't deal with our bad debt expense. We're only dealing with ADA and account receivable. All right, so that's kind of just a very, very broad overview. Let's put this into practice. I'm going to put the allowance method here, so you're able to kind of see this thought process. And we're going to do a practice problem. I'm going to give you guys 10 minutes when right when I finish up the first part of it. Everyone work through it. Once I finish it up, I'll start walking around and answering questions. For anyone new, if there's any words here that look illegible, I apologize about my handwriting. Let me know, and I will help you. I'll rewrite it, or I will, or I'll rewrite it, and I'll also say what it is. Oh, chapter 7. So I'm writing down a problem for them to all work on their own. We're gonna walk around the room and help out.
Sorry, I'm late. I had someone in office hours.
That's not good.
Okay, I have like 10 minutes where I have to leave to pick up my son. So I'm just gonna interrupt for a second. Does anyone have any specific questions that I can help you with before I'm done? Okay, we'll talk.
Question, is everything legible, or is there anything that can't be read?
The second one, what is the be able to what?
Be able to, it says like 6/ of AR. I don't,
Oh,
why is it,
the
is that
company,
6%?
yes. The company estimates it will not be able to, oh. Okay, that's not spelling error, that's just a my brain error. Will not be able to. So the company estimates it will not be able to collect 6% of account receivable.
I got another question.
Yes.
So for the last one, second line, I can't read that at all.
You're good. Sally has come back with cash to pay, record the reinstatement of the account in cash collections.
Statement of the,
Oh, thank you. Well, because of Zoom, I'm able to use it for the whole thing. You see what's missing if I don't have Zoom? Yes.
of the account, and what's the last thing in
Cash collections.
Cash collections. All right, sounds good.
Yes. That's not, this is not easy, that's a very different. Oh, yeah, this is that. I did it. Speaking of real quick.
You be going to credit cards for the exam. Okay, cool. Ignore everything about credit.
Don't worry about credit cards. Really, we put that in there to show like that's really not what we're focusing on. It's like a receivable with a credit card company. We're trying to be like directly receivable from a specific customer. So don't worry about any sales on bank credit cards.
I did it just in case.
Yeah, no worries.
So therefore, you're not receivable, you kind of, you know that is now.
So you don't ask for us. Right. Okay, so.
So it's gonna credit for this.
Okay.
You're okay, that's actually perfect. Let me put that real quick. Y'all, I forgot to say, that 3,000 is a credit.
Basically, we add them together because they're both connected. It's just that first account receivable is the beginning balance. Just figure out where.
Yeah.
Okay, perfect. So for the T.
So basically, this is your beginning balance, you put it at the top, and then whenever you see credit sales, that's a keyword for, okay, that's more account receivable. Because that's all the credit sales. If you ever see like credit sales and then cash collections, you know that's gonna be a credit, because cash collections is when we're going through our account receivable and getting money from. But that credit sales, anytime you see credit sales, that's account receivable. Yes, and I did put 1 million. Oh, yeah. Check on into went well, we went through all of it, and I've been reporting too, so all this is going on. So how to start it first is getting a percentage, getting what. Sorry, my brain is way too fast on this. So first things first is get yourself a T-chart for both account receivable and ADA. It works all there. Okay, now first, this is your beginning balance for your account receivable. So where does the beginning balance go? Yep, it just toss it in. Well, ADA isn't gonna, ADA isn't like a subsidiary. We're only working control accounts. The biggest reason we talk to you guys about subsidiary is just knowing that account receivable can be broken up. So, where do you make the beginning balance of your account receivable? Does it have a normal debit balance?
Yes.
Okay. Now, credit sales, what does that make you think of? Now, does that bring your accounts up or down? Perfect, so that's a debit or credit. So, does account receivable typically have a credit balance? This one right here? Nope, we're using that same account receivable to chart here. So, does it normally have a credit balance? It's gonna be on the debit side. You think every credit sales is a debit to account receivable and a credit to Yes, because think of it this way, credit sales means sales that never got cash. Basically sales on a credit card. Think of that way. So then you add them together. Yep. 1.3, and then you take 6%.
Yeah.
So you have these three. Yes.
Okay. So this balance is right, so I would do it.
So what you're doing here, this is figuring out, we're saying here that we're thinking that this amount is gonna be uncollectible. Now, that doesn't mean we're gonna write it off right away. What that instead means, we'll bring it into a ADA account. Now, this is the bond. This is the total. And does your ADA have a debit or a credit balance? ADA is a contra asset, meaning it's gonna have a credit. We'll always have a
Opposite of that.
that's the.
Okay, I understand. So we
Put it at the ending, because this is your ending. Does that make sense so far?
yeah.
So where do you think this beginning ADA balance goes? Perfect.
But it's letting you know that you have it.
Now you need to figure out how you got from here to here. Okay, now what's your journal entry? What's your adjusting entry?
So what is that 75?
It's basically us fulfilling our water bottle. Let's say our ADA account is a water bottle, it's pretty empty, not debit. Just think of it this way, you had to go from 73 to 78. Yep, it's another credit because now what's gonna be that journal entry? If you think of it, it's,
So we had it.
so this has already been here, this is new. We have to make a journal entry.
Minutes to watch my stuff.
Yeah. Yep, credit of 75,000, but what's our debit? What's our adjustment? What do you think when you think adjustment entry? Mhm.
So that makes sense the same.
Mhm.
So it's like the flows. Why is it on the credit side?
Because that's not bad debt expense.
That's 88. Oh, okay.
That's why we're doing it. That's our adjusting entry.
Okay. And then we'll do credit, which is. Yeah.
Mhm.
Right here, which is 88, 88.
Not 3K. Yes.
Are you wanting me to like record the adjusting entry and then go on to write it off? Or
Yes.
do you want them to like write off and like take that into account? How it affects your-
This is all just journal entries. Okay. No, you're good.
So not 3K?
Not 3K, because 3K is already there. Nope. So how do we make our journal entries equal?
Yeah, so basically your ADA and your
Do our debits have to equal our credits?
Yes.
So what does it have to be? These things, this is new. We have to make a journal entry to place that there. So this can't exist without this. That's why when we put a number here, we have to make a journal entry here.
Okay. And this regular.
So this wouldn't be anything with the 75K. So this is something new. We're saying Sally can't pay her balance of 7,000, so we have to record a write-off. How do you record a write-off?
88.
Yep. And how much?
3,000.
How much can she not pay?
Oh, so
There you
That's it.
go. So we're getting 300. So is that per account receivable or is it all accounts?
So with the, is the bad debt expense 78 or 75?
So it's 7,000.
Are you, Monty, you're having them add the million to their accounts receivable balance? So they're doing the 6% off 1.3 million?
Yes.
So what?
So you took, how did you get the
Because you're
78,000?
taking that
The
away, you're
70,000
saying
of
you're writing
the
off her
ending
account.
of the ADA,
We're saying that
that's
account is
6% of
no longer
1.2 million.
in
I didn't add it.
Perfect.
Yeah.
So then, yeah, then 75,000 is what you'd report in your adjusting entry.
Journal
So that's
entry, you write your
the
journal
bad debt
entries
expense?
properly.
That's what should be the bad debt
Okay,
expense.
and then, but so is
Because it
the,
will be
for like
accepted
the
as
journal
an
entry for the ADA,
Mhm.
is that also 75 or is that
If
78?
75, because you have to balance,
Okay.
right? So you're gonna record the same
Okay.
amount to each account.
I just want to make sure you're good for the ads.
Okay, thank you.
You're welcome.
So how do we get from 3,000 to 78,000?
Which I don't understand, I just don't understand.
So how do we add 75,000 here? Is that a debit or credit?
Yes.
Perfect. You have part of your journal entry. What you done? So why would you debit 78,000? Because we're trying to make a journal entry to adjust here. One, 75,000. So you know your credit's 88, 75,000. What you have to debit to add 75,000 to your one? Not 3,000. Your debits and credits have to be. For what account? What account are you debiting?
So your balance, you started with a certain. But now we're trying to.
So are you adding more to your account receivable? What's your adjusting entry?
Does that make
What do you think
sense?
of when you think of adjusting entry?
So you can combine this, you're speaking about your AR. You would start off with.
There you go.
So that's what I'm doing. You have another debit of $1 million.
I know, the figure reducing a cookie jar thing, right? Think of it this way, you're refilling your cookie jar here. That's how many cookies you need to refill from your cookie jar, and bad debt expense is what you use.
And that's how.
Yeah, that's what I'm sending out.
Key cans are good because you just need to pay for things, that's why I use them. But I can see how you guys are getting confused on like 78. The only number we're worried about here is that 75,000, because that's what we need to get here. We're trying to figure out how much we have to use, so that's how much we have to use.
What's 78,000?
And then for the write-off, they just.
The write-off? Yes, so that, but your totals are off, so why are you writing off 300,000?
That's just what I had before. Yeah. So this one was right?
Yes.
No worries.
Have a good one. Thank you. Bye all. So if you don't have any questions.
Yes.
Thanks, Mom. We do the best.
Yeah.
Yes.
You're going in the middle. I'm like mixing, I'm mixing up like different totals for like problems I saw in your practice. That's what, yeah, that's why we ended up with the big numbers.
Awesome. Thanks. See you. Have a good one.
All right. So, are you still confused as well?
Should we just switch it for the last one?
Yep.
Okay.
Because you reinstate the account, so.
We already have all the information, though, right?
Yep, so we're reinstating and then cash collection.
So if it was accounts receivable, a lot of people just switch to 88.
It's always gonna be in that way.
I don't know how to record this. What we write now? Well, it's the same thing. It's
Yep.
Yeah, it
Okay.
doesn't.
Because you're reinstating the account.
It's just this.
It's not hard.
Yeah, it's just remember.
That one, how do you report that?
Like here, I'll remember. And then the test of it.
If I look at this, other parts of that, I can find. This is just.
Is this where you're using your, right, this is where you're using your 88, this is where you're using your allowance. We're throwing away our cookies.
No cash.
So just like cash and motion goes, so you get $7,000.
Yeah, it is just cash debit 7,000 and accounts receivable 7,000.
So it's usually like some of this.
Yeah, because you're actually taking the money from them now that they're actually paying it, so you have to debit cash and then lower the account receivable. Yeah.
Oh, my. So much.
It's just remembering these stupid steps.
Oh yeah.
No, I am so lost right now.
Once you're actually
Really?
somewhat
Just ask
familiar.
her.
I understand. Once she explained it to us, I understood it. But just looking at it, it's really
Yeah.
confusing. Yeah. And then I didn't even notice the cancel.
Oh, really?
Yeah, I totally did that.
There you go.
No, more insult to injury. This is by far not the most difficult class to take.
What's your major?
So I used to be an engineering major, so I went all the way to like differential equations and like more linear algebra type math, which is like, it's insanity.
I hate that so much.
Yeah.
I have this in like my managerial accounting. I should be done with like action.
It's not hard math. All right, the teacher that I have.
So we're gonna start running through all this.
Instead of
I'm gonna
whole
need
class
it.
period.
Yeah, do regular class work to find out who's good and who's not.
Yeah.
So
Um,
first things first, what you want to start doing is making T-charts to start these questions off, because honestly, T-charts are the best way, I think, to kind of keep track of all of the mess that is chapter 7. So first things first, we're going to worry about our account receivable. If you notice here, and I know this is a very small detail, but it's good to notice, we're doing this 12/23, and I'm going to put a 2022 here. So this is the end of the year. This is our beginning of the year account receivable balance. So we know at the beginning of the year, we had 300,000, and we had $1 million of credit sales. Now, $1 million of credit sales mean we sold on credit. What account is that? Assets, but what specific account? Account receivable.
Oh, yeah.
So we had credit sales typically means we sold on account. So it's good to know because you're going to be seeing credit sales as a key terminology for account receivable a lot. So we know our total account receivable balance is 1,300,000. Big number of money to be owed. Now, of that 1,300,000, we think that 6% is uncollectible. We will not get it. So we are then going to multiply this by 6%, which is 78,000. So we think 78,000 is not going to be owed. Now let's start working on our ADA account. We know it has a credit balance of 30,000. But we want to get it to 78,000. That's why we do this math here. This isn't adding or doing anything to our account receivable at all. It's not touching our account receivable at any point. This is just us doing a math equation to figure out this grand total of 78,000. Now we have to figure out how we got from 3,000 to 78,000. And from that, we have to figure out, okay, X. If you ever need to make your T-charts into a math problem, 3,000 plus X equals 78,000. A lot of y'all were great and knew, okay, we have to subtract 3,000. We got 75,000. That 75,000 goes in this box. We're saying 3,000 to 78,000, that's 75,000 we're missing. Now, journal entries are the law of the land. You can't do any of this tossing into T-charts without journal entries. Every amount here had a journal entry tied to it. You just don't see it. But the journal entry this is asking for is recording the adjusting entry. Adjusting entry, updating entry. This is where we see our bad debt expense used for that 75,000. And we are crediting our ADA. Any questions so far? So that 75,000 is our adjusting entry to get from 3,000 to 78,000. Will we see bad debt expense any further with any of these questions? No. You'll only see the bad debt expense with the adjusting entry because that's what we're using to fill up our account. Now, with these two questions, we don't need anything else. We don't need to know any other key factors because all we need to know is how to write off an account. Now, to write off an account, you're going to take the allowance for doubtful account. This is where we're using our allowance for 7,000 because we know she can't pay 7,000 and we're recording a write-off. We're then going to take our account receivable and we're going to lower it by 7,000. We then have Sally come back and say, hey, I can pay it. I have the cash. So we want to record the reinstatement of the account and cash collections. This is two separate journal entries. We can't just go, okay, cash account receivable, cash ADA. We have to then reverse over our account receivable, debiting it to put back that 7,000. And we are going to credit allowance for doubtful accounts for 7,000. We now have her account back in progress, and then we're going to then say, all right, cash for 7,000 has been grabbed, and account receivable has officially been lowered in the way we want it to be, in the way we get money. Any questions in this throughout any of this process?
Is this exactly how it's gonna be on this test?
This is exactly how it is. Not question for question, but this is a method you need to know. You need to know those keywords in the call out and know the relationship. There might be examples where it says, okay, there is allowance for doubtful accounts has a debit balance of 3,000 instead of a credit balance. You still have that 78,000, but now you have to figure out what you put in this empty space. One way to know is you add 3,000 plus 78,000 to get 81,000. So your bad debt expense is now 81,000 instead of 75,000. Kind of visual of that is you have to take 3,000 to cross out that 3,000 there, make the account 0, and then credit 78,000. Adding that together is that 81,000. Sometimes you might have this question start off with, all right, not only did we have credit sales for this amount, we also had cash collections. If for some reason you're asked for cash collections, know that cash collections, you're going to toss that into the credit of your account receivable. Whoa. And you're then going to decrease it by that 100,000. So instead of 1,300,000, it's 1,200,000. Does that make sense? Those are just some of the variations. It is picking up those keywords. Adjusting entry always is going to be bad debt expense ADA. That's the only time you're ever going to use it. Write-offs will always use allowance for doubtful accounts as a debit and account receivable as a credit. The percentage method will always take the total of your account receivable, multiplying it by a percentage to get your ending ADA balance. And that will be tossed to the ending of the ADA. And you're going to have to figure out how do you get from the beginning to the end. And that is your adjusting entry. Any other questions?
So cash collections is credit.
Mhm. think of it, cash collections, whenever you're collecting the cash, the journal entry to cash collect will always be that cash and account receivable. Any other questions? Nope. All right. Is there anything that you guys want to work on in this last 8 minutes? Any last minute questions, anything? Otherwise, you all are free to go. Thank you for putting up with me for 3 hours. Yes. Exam review session.
Thanks for the help.
Yes, thank you.
Yeah, I feel like I went from I'm completely lost to
No,
I'm
yeah.
gonna
might
do
get a
tons of
sense-
these
No,
problems.
yeah, same.
Like,
I believe you.
I'm just
No.
gonna be grinding at home.
Oh, no worries. If any of y'all have any questions, feel free to reach out to me or Miss Yeager. Try out some of the blue kits, use those study guides. It's not gonna be 1-for-1, but it's gonna give you more practice. Not only that, but if no one's part of, if some of y'all aren't part of the group me, feel free to use that as a chat room to talk about stuff with each other as well and all talk about understandings, because sometimes it does take a village to understand accounting.
So is the vocab mostly on chapter 1 and 2?
Vocab is mostly on chapter 1 and chapter 2.
Do these sessions only happen before an exam?